In this week's video, we'll review the latest charts to help us answer the question, will shifting rate expectations send stocks into orbit? At the end of the trading week on Friday, November 5th, we had both the Fed meeting, which included the taper announcement, and the monthly jobs report behind us. It's interesting to note in the center of your screen down here, this is a chart of interest rates, or the yield on a 10-year Treasury, as of the close on Friday, November 5th, and you can see interest rates have fallen quite a bit. So we really don't have to guess that rate expectations have come down. We can see it here. We have visual evidence. The recent decline in rates began after the close on October 21st. Rates declined further after the Fed meeting and even further after the monthly jobs report. Since we're fully entrenched in a bull market and the S&P 500 is making a series of new all-time highs, the real question is, how will this impact asset class behavior and, more importantly, asset allocations? We can find the answer to that question in the remainder of the video by reviewing the charts. The tweet in the upper right-hand corner of your screen speaks to a topic that we've covered on multiple time frames in recent weeks and months. And that's when the trend in the stock market is strong, it tends to be followed by additional strength. That was something that we covered in the September 17th video. You'll remember the stock market peaked on September 2nd. It did not bottom until October 4th. But the facts that we had in hand on September 17th and an incredibly strong trend in the S&P 500 told us, despite the weakness that we had in mid-September, that we should remain open to much better than expected outcomes looking out 1 to 5 years. And that analysis also told us that some type of pullback, maybe even a pullback in the order of magnitude of 4% or so, was 100% normal and to be expected relative to the historical cases. A lot of the charts covered in this week's video are dated November 4th, and there's a tendency to think that they're out of date. This portion of the video is being recorded after the close on November 5th. None of the commentary that follows needs to be edited. Here are two charts that we'll cover in detail. These are as of the close on November 5th. This gives you a reference point. There's no significant change over here, nor is there any significant change here, nor was there any significant change to any of the charts that we cover relative to our longer-term time frame. Given the S&P 500 has recently rallied to new highs, it may be relatively easy to forget that it recently closed at 4,300. It may also be easy to forget the scary headlines that were floating around after the close on October 4th. And very, very similar to the look of the charts in mid-September and into early October, we didn't really have anything down here where my cursor is, and we really don't have anything in the present day that tells us the longer-term bull market is in jeopardy at this point. Does that mean everything is rosy? Absolutely, positively no. You can find things to be concerned about 365 days a year. That comment and the look of the chart in front of you and the trend in front of you speaks to the interpretation or the weight of the evidence, the interpretation of all the information that's relevant on all time frames. This is a daily chart on November 4th. We have that full-bore bullish look. If we look at a weekly chart of the S&P 500, we look at TSI and weekly MACD measures of momentum, and we look at ADX, a couple of things jump off the page. Had a lot of asset class shifts in this area here where my cursor's moving around. The market did well, but that doesn't necessarily mean everything did well in here, especially on a relative basis. ADX showed an extended daily trend in the S&P 500 here. Black ADX above both green and red. Contrast that with the sleepy trend look, early stages of a new trend look that we have on weekly ADX in the present day. Now we have black below both green and red. And that really speaks to this consolidation or sideways movement in here. Now we have the break to the upside, and momentum is just starting to turn back up, telling us to keep an open mind about the market moving higher in the weeks and months ahead. And we all know the longer a market goes sideways, the bigger the move that we can expect to get when we either get a bullish breakout or bearish breakdown. This is somewhat of a risk-on, risk-off ratio. This is SPY versus GLD, or gold, physical gold in the ETF world. We're inside of the blue box here for 4 years and 8 months. And then we break out of the box just recently, earlier in 2021. This period of consolidation started 2 years and 8 months ago, and this is the orange box here. This is a high in 2018. We exceeded that high earlier in 2021, somewhat of a retest look here, and now it looks like a successful breakout to the upside. So this is 4 years and 8 months. This is 2 years and 8 months. We've only been above the box in a convincing manner for about 5 months. It's a daily chart of FTech, a technology ETF relative to the S&P 500. This is Q1 of 2021 when tech started to underperform. Here's the drop from A to B. We retrace 61.8% here where my cursor is. And then for the most part, the ratio has been consolidating here for several months. November 4th, we have what appears to be a fairly convincing breakout or breakout attempt above that consolidation box. The longer the ratio stays above this 61.8% retracement, and the further it moves in this direction, the higher the probability that the long-term trend of tech outperforming the S&P 500 is getting ready to resume. This still has some work to do, but it's made quite a bit of progress since May of this year. A lot of ways to slice and dice and weight tech in the ETF world. Here's IYW relative to SPY. In this case, it looks even better. Here's the 200-day moving average. Recent consolidation has been above an upward sloping 200-day in red. And on November 4th, this printed a new all-time high. Very, very difficult to get too bearish about this ratio on November 4th. Also noteworthy, we're consolidating inside of the blue box here. In recent weeks and months, the consolidation has occurred above that blue box. This over here looks better than this back here. And we have a breakout from this orange box, consolidating for 3.5 months. We also have a break of a downward sloping trend line, and now we're making a series of higher highs and higher lows again. All of that occurring above an upward sloping 200-day moving average. Similar situation here, triple Qs relative to RSP, an intermediate term downtrend here. We've made it back to the 61.8% retracement. This chart has a little bit more work to do relative to the previous chart, but it is showing some signs of improvement and possibly trying to get back on track relative to the longer term trend. Very, very similar situation here. This is growth stocks, SCHG, relative to SPY. This is May of this year. Quite a bit of improvement between point A and point B in terms of trying to resume the longer term uptrend that favors growth over the market. It would be even more convincing if we can clear this high here and break above this long period of indecisiveness and consolidation. Also noteworthy that this consolidation occurs below the 200-day. All of this has occurred above the 200-day. This gives us a little bit of an example that even though the S&P 500 was still marching higher from April of this year, you can see there was a lot of internal weakness. This is S&P 500 stocks, the percentage above their 50-day simple moving average. Here's a decline from point A to point B. We're just now getting above the 61.8% retracement. The longer we can hold that level, the higher the probability that good things will happen. It's a subtle little shift here. This is total U.S. new highs minus new lows, looking at new highs and new lows on several major indices in the United States. Consolidation in here, this is a subtle little shift or maybe mini breath thrust here. Notice where it occurs in November of 2020. If you know your market history in the rearview mirror, there was a very, very strong rally in growth or risk assets in here, really economically sensitive assets. Similar situation here. We've been consolidating for several months. Now we're above the orange box. It's subtle but noteworthy. Everything that we said about the last chart applies here. Subtle shift here. November of 2020, the S&P 500 marched higher. We have a subtle shift here as well. This is the highest reading that we've seen. We have to go all the way back to March of this year. This is also a slight bullish divergence here relative to the S&P 500 making a low here. There's that indecisive look between the equal weight S&P 500 RSP relative to SPY that we've been talking about for some time. This is the look here. This is about as indecisive as it gets. Back on October 8th, we're sitting right on the 200-day simple moving average in red on October 8th, and we're sitting right on this longer-term downward sloping trend line. We're also sitting just above the June 2020 high here. So if we fast forward roughly a month, has this chart improved or deteriorated? If we zoom in a little bit on the same chart, it's deteriorated a little bit. See, back here, we were right around the 200-day. Now, we're well below that 200-day. We're also below that June 2020 high, and we're also below this downward sloping trend line. Also noteworthy, I mentioned this several times in recent weeks. If we're expecting the market to behave, an asset class behavior to behave in a similar manner to what happened in Q4 of last year, we really don't have that look. This is November of last year. This is when small caps really started to outperform in this window here. Notice the ratio. It breaks above a multiple week, multiple month consolidation box right here. It breaks above the 200-day moving average in red, and soon thereafter, before year end, the 200-day starts to turn up. That's almost the polar opposite of what we have over here. The 200-day moving average is starting to roll over in red, at least flatten out, and instead of breaking to the upside after multiple weeks or months of consolidation in here, we're breaking to the downside relative to this multiple month consolidation box here. We're not making any assumptions about what this chart's going to look like tomorrow, but on November 4th, this really doesn't look anything like this relative to what we would expect with asset class behavior. The S&P 500 bottom made its final closing low on October 4th. On October 8th in the video, we covered this subtle little shift here in the TLT-SPY ratio. We closed below this green line here that for the most part had bounded price, dropped below it here, and then we made a lower closing low on the 8th. Hard to make an argument on October 8th that this is positive for defensive assets. If we fast forward to November 4th, and of course the stock market's done quite well between October 8th and November 4th, the ratio is still holding that bearish breakdown and still below a downward sloping 200-day moving average. In terms of the market rallying, this was a good sign back on October 8th. Small caps IWM relative to TLT had been in a downtrend since March of 2021, finally broke above it on the 8th of October. This tended to be good for the general stock market and good for stocks in general. However, if we look at small caps on November 4th in isolation, it's somewhat of a good news, bad news story. This is really, really good news here. The longer a market goes sideways inside the blue box, the bigger the move that we can expect to get. We do have a bullish breakout on November 4th intraday that's holding. And in terms of small caps or IWM or SCHA in isolation, this is a bullish development. And somewhat similar to this bullish development here in early November of last year. This is a bullish breakout. The longer a market goes sideways, the bigger the move that we can expect to get. There's a big however coming, and it speaks to how we would weight small caps in the portfolio. Here's small caps in isolation. This is the bullish breakout in November, early November of 2020. Notice the small cap index versus the S&P 500 on a relative basis is also breaking out simultaneously. This means small caps in November of last year are leading the S&P 500. So this is a bullish breakout for a market leader. It's a lot better than what we have on November 4th. We do have a bullish breakout, and that is a good thing. And that means SCHA or IWM, from a probability perspective, the odds are probably better today than they were back in here. But instead of being at the top of this box, we're at the bottom of the relative box. Look how far away the relative line is down here versus March. Now that can change quickly, and it may change, but it hasn't changed yet. So if we're going to increase exposure significantly in any way to small caps, we're going to need to see some improvement down here. Keep it in mind, the market bottomed on October 4th. On October 8th, this chart was telling us to be open to things shifting. This here on October 8th, broad market versus bonds, looks different than anything that we've seen in here where my cursor's moving around. As of November 4th at the close, this bullish breakout is still holding above an upward sloping 200-day. This is a chart dated October 7th that we covered in early October in one of the videos. This is value VTV versus growth, just making the point that the long-term trend, for the most part, is still down. And the gains that value had made in here, where my cursor's moving around, were for the most part given back as of October 7th. If we zoom in on that chart, you can see this was the chart that we showed in early October. And things haven't improved for value over the past several weeks. They've gotten worse. In fact, during the session on November 4th, we were making a multi-month low in the ratio. We have to come all the way back into this general area back here during the session on November 4th. So if we thought from a longer-term perspective, we really didn't want to overweight value relative to growth based on this chart on October 7th, if anything, it's gotten a little bit worse between October 7th and November 4th. The good news for value, this is still inside of a consolidation box here, and as long as you're inside of this box, there is some hope that this consolidation would lead to a reversal. But our allocations are based on the chart in front of us, this look and this look. Remember, when we're looking at relative charts, it doesn't mean VTV in isolation is a dog. To the contrary, almost all of these ETFs are making new all-time highs in isolation, or they're near new all-time highs, meaning VTV in isolation is still healthy and still in a bullish trend. These charts help us with weightings. How many dollars do we want to commit to VTV relative to VUG or SCHG? If we look at VTV versus VUG going back to 2009, this is a 50-month moving average here in blue. The longer-term trend is unequivocally down. However, you still could see a lot of outperformance in VTV even if you just go back to the downward sloping 50-month. Also, as we've mentioned in past videos, when the market makes a major low as it did in calendar year 2020, sometimes you see outperformance for several years off of these lows, telling us to keep an open mind about a wide range of outcomes despite the look of the chart in the present day. There's still a lot of white space in here. Markets tend to like to fill white space at some point. The long-term trend, unquestionably, in growth's favor. Now it looks like the shorter-term trend may be switching to growth's favor as well. Let's call it the intermediate term trend. This is 14 months of whipsaws and indecisiveness in here in terms of asset class leadership. Could show a ton of charts that show similar indecisiveness. This is the Citigroup Growth Index relative to the Citigroup Value Index. It looks like we're getting a bullish breakout attempt here from this 14-month consolidation box. The longer the breakout holds, the more relevant it becomes. Here's another way to look at asset class behavior from November of last year. If we're expecting asset class leadership to be similar to what we saw from November to, say, the spring of 2021, in that case, small caps were a big leader. A lot of economically sensitive or reopening trade stocks did extremely well. Growth underperformed. And you can see in early November here, growth relative to the S&P 500 plummeted. This was resistance here, and this is where we established this downward sloping trend line. Compare and contrast the look here in November to the look in the present day. Here, we're back above that downward sloping trend line. Here, we're below blue, red, and green. Here, we're above all of the moving averages, and it looks like the moving averages are trying to turn up in a bullish manner simultaneously with recapturing the downward sloping trend line. This is still consolidation, so we don't really know who the longer-term winner is here, but there's no question that it's been improving in favor of growth since May of this year. Very similar comments relative to tech. Underperformance begins, you get the downward sloping trend line. Then in the summer, we're above that trend line. We've been, for the most part, consolidating above the trend line, consolidating for several months. And on November 4th, we're trying to break out of this multiple month consolidation box in a bullish manner. Also noteworthy, the left side of your screen, the long-term trend unequivocally still favors tech over the S&P 500. Here's your downward move, A to B here. If this was a new downtrend and tech were going to underperform, we would expect a counter trend move to go back to roughly the 32.8, the 50 or 61.8, and then resume the downtrend. And that just speaks to probabilities. Well, that's not what's happened at all. We've come back up above the 61.8 since July. And for the most part, we've been consolidating above the 61.8 in this little box here. And now we're trying to break out of that little box. And we're above the downward sloping trend line. So as of November 4th, we're not predicting what the chart's going to look like tomorrow. It looks like tech is trying to resume the longer-term uptrend relative to the S&P 500. As we've mentioned in past videos, technical analysis is about subtle shifts or changes in human behavior. This is the close on September 30th. This is XLK relative to TLT. This is 2 trading days before the S&P 500 bottomed on October 4th. So the S&P 500 has been falling for almost a month in here. And during that time, in this window here, this ratio was still inside an upward sloping trend channel, denoted by this line and this line. So when we covered this on October 1st, we basically said, hey, this really doesn't look that bad. For the most part, above this orange box where my cursor's moving around, and we're definitely staying above this dotted line here. If we fast forward from the September 30th chart to November 4th, you can see the S&P 500 down here did eventually bottom, and we're still holding this trend here, this uptrend. If anything, it's strengthened and improved. Why is this relevant? Because typically corrections are deflationary or fear-based events. And this same ratio during a correction in 2010 looked like this. During a correction in 2004 looked like this. It's really not what it looked like on September 30th. And 2 trading days later, the market bottomed rather than rolling over further. Similar situation here, NASDAQ trying to resume the longer-term trend of leadership over the S&P 500 still has some work to do. From an asset allocation perspective, it's been a little bit frustrating at times over the past 16 months because we really haven't had clear leadership. It's possible with a look like this, a look like this, a look like this, and a look like this, that we may be inching closer to a period where we do have clear leadership. The leadership before this long-term period of consolidation, the real leaders were tech and growth and the S&P 500 itself. If we resumed this look over here, right now it looks like the clear leaders might be tech, growth, and the S&P 500. We're not quite there yet. And as we mentioned last week, our weightings reflect all of that. We're respecting the longer-term trends, and we're respecting the indecisiveness that we've seen in recent months. And we say the long-term trend favors the NASDAQ over the S&P 500. That's a lot easier to see when we look at a long-term chart. There's really nothing here that's happened recently that looks anything other than consolidation within the context of an existing uptrend. The one caveat would be that we are somewhat extended from this 50-month moving average, and even if this uptrend resumes, it wouldn't be shocking to see us come back at some point closer to that upward sloping 50-month. The recent trend has been for the NASDAQ to outperform the S&P 500 after this period of weakness from point A to point B. And you'll hear a lot that the NASDAQ's in a bubble. Somewhat hard to listen to the bubble talk when the NASDAQ is just on a relative basis trying to clear the high that it made all the way back in the year 2000. Markets operate in fractals. This is a long-term period of consolidation. We can draw a horizontal line from point A to point B. Price has gone absolutely positively nowhere for approximately 21 years. A bubble is typically extended, significantly extended from a box like this. It's a chart from the October 8th video where we said we're a little bit skeptical about energy from a longer-term perspective. You can see the ratio was at 0.129. It's actually gotten a little bit worse as of November 4th. It's down to 1.23. Nice period of consolidation here, but even if we get a breakout, could be somewhat of a bullish trap with this downward sloping relative trend line waiting out here. No question, energy has improved since this October low in 2020, and it's above an upward sloping 200-day moving average in red in terms of the ratio of XLE divided by SPY. But from a longer-term perspective, for us to add to our relatively small allocations, we would need to see this ratio get out into this area here and start making a series of higher highs and higher lows. Could spend a lot of time here. The principle of what once acted as resistance or what once acted as support may now act as support or resistance. We're stalled in this general area out here. This is the energy index. If we look at it on a relative basis, relative to the S&P 500, we're stalled right around a downward sloping 200-week moving average shown in red. The last thing the relative ratio did was make a significant lower low down here. It has not yet made a higher high above this high in 2018. And even if it does, it still has to contend with this downward sloping trend line in here. Very, very similar concepts here. Financials look a little bit better because the ratio today, October 7th, this chart, is above this downward sloping trend line. So this is more of a consolidation look here. Definitely has work to do from a longer term perspective, but it looks a little bit better than energy on a relative basis. The NASDAQ 100 up-down volume back on October 4th. You can see if we drew a trend line in here, we break it somewhere in this area here. But if we fast forward to the data as of November 3rd, you can see we've shot straight up to a new high above this area of consolidation. This is the chart that we covered on October 8th. This is stocks relative to bonds. Think VOO or SPY divided by TLT in the ETF world. Once again, kind of hard to say we're in a bubble when that ratio is just clawed its way back to the exact same levels all the way back in the year 2000 here. These are the bearish looks that we talked about before. The ratio is falling, moving average rolling over. Ratio falling, financial crisis, moving average rolling over. Full bore bearish look here. Full bore bearish look in here. Today we have a full bore bullish look. Instead of the ratio falling, it's been rising significantly in the rear view mirror. Tough to make an argument that on October 7th, this over here looks anything like this over here or this over here. Once again, we're making statements about the chart in front of us at that time as of October 7th in the October 8th video. How does it look today? Looks even better. It's holding that long-term breakout, and we're above this level here from the year 2000. And all of this aligns with the demographic story that we've covered in the past in one of these weekly videos, and aligns with this topic here from this article dated April 28th of 2020. We've shown several charts in recent weeks and months that say we should be open to tech and growth resuming their long-term uptrends or leadership trends relative to the S&P 500. However, if we're going to maintain that flexible, unbiased, and open mind, we should also look at the same charts with a skeptical eye. What do we mean by that? This is high beta relative to the S&P 500. Here's the look in November of 2020. So if we're expecting asset class behavior to be similar to what we saw in Q4 of last year into the spring or early summer of this year, we really need to see this improve. This over here really doesn't look anything like this lame look here where we're kind of hanging around that 200-day moving average. But if we look at the chart with an open mind, this look here, we really could have made similar statements in here. So if we cover this up and we didn't know this was about to happen, this really doesn't look that good in here, and then it changes abruptly. And this abrupt change can often be triggered by changes in interest rates or expectations about inflation or Fed activity. So see this abrupt shift here? Very, very fast. It could happen again on a lot of these charts. And this helps us maintain maximum flexibility, remain open to all outcomes, helps us trade the chart in front of us, and that's the chart we have today. But we shouldn't make any assumptions that this somewhat feeble look here is going to continue, because it looked relatively feeble here. In fact, the 200-day was downward sloping right here. Today, it's upward sloping. You can pause your video player here, but the tweet on your screen, it basically says when the S&P 500 gains 5% or more in the sell in May and go away period, when it reaches the more favorable period, so when stocks do better than expected during an unfavorable seasonal period, what happens next in the favorable period? Really good things tend to happen. Between the end of October, let's say 10/27, and May of the following year, so this would hypothetically be May of 2022, the average gain was 12.27% in the S&P 500. The median gain was 10.81%. Every single case, the market was higher or at least flattish. Here, up less than 1%. Here, up fractionally in 1968. Markets move based on the weight of the evidence. You'll hear a lot of reasons as to why the market's moving higher. This is a big one right here. Earnings. A lot of improvement here on the left side of your screen. You can pause your video player here, Ryan Dietrich. When the market's done this well, year to date, the final 2 months of the year, typically continue. Things continue to do well. Average gain, 6.2%. Simply helping us keep an open mind about a wide range of outcomes, including better than expected outcomes between now and year end. And we all know the only way that we're going to be able to react properly and recognize what could potentially be abrupt change, since we still have a lot of consolidation looks on charts, is to head into next week and every week with that flexible, unbiased, an open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.